Welcome, everyone. My name is Ayana. Today, I'll be leading a training session on how to conduct a sensitivity analysis in the context of capital budgeting. We'll explore how this analysis helps financial managers assess risk, identify key variables affecting a project's success, and make more informed decisions. Financial management's primary goal is to maximize shareholder wealth through sound investments and financing decisions. Managers must evaluate how to best use financial resources to generate long-term value. Capital budgeting identifies projects that deliver profitable returns while managing risks. Sensitivity analysis tests how changes and assumptions affect outcomes such as NPV, IRR, or payback period. For example, if sales decrease by 10%, how does that impact project profitability? This method helps managers identify which variables have the greatest influence on results. This graph compares the NPV profiles of Project 1 and Project 2 at different discount rates. At lower discount rates, Project 1 is more profitable because its NPV is higher. However, as the discount rate increases, the NPV of Project 1 declines more quickly. Around the point where the lines cross, both projects have the same NPV. Beyond that point, at higher discount rates, Project 2 becomes more profitable since its NPV decreases at a slower rate. In other words, Project 1 performs better when the cost of capital is low. But Project 2 is the better option when the cost of capital is high. Quantitative analysis involves manipulating measurable financial variables. NPV sensitivity graphs show how sensitive project value is. Scenario analysis compares best, base, and worst case outcomes, while Monte Carlo simulations test thousands of variables combined. You're a manager trying to decide whether your company should invest in a project, such as building a new store or launching a new product. You want to know if things don't go exactly as planned, if sales drop or costs rise, but we still make money. That is exactly what this sensitivity analysis and risk simulations do. Not all risks are numerical. Qualitative factors like leadership strength, brand reputation, or political stability can significantly affect a project's success. Evaluating these elements give a more holistic view of project risk. Integrating risk means recognizing uncertainty in both internal operations and external markets. Internally, we might increase the discount rate to account for high project risk. Externally, we analyze market trends, economic conditions, and industry validity. In conclusion, sensitivity analysis provides insight into how risk affects investment outcomes by blending numerical models with human judgment. Organizations can create flexible strategies to respond to market changes and uncertainty. These references provide additional insight into financial management, capital budgeting, and sensitivity analysis techniques. Thank you.